Hello and welcome to the Small Business Briefing Thursday edition. I'm Brian Calley, for the CEO of the Small Business Association of Michigan.
Hi, everyone. I'm Sarah Miller, Vice President of Marketing and Strategic Communications for SBAM. Thanks for joining us. And of course, thank you to our sponsor, Consumers Credit Union, for your generous support of the show. So Brian, where are you joining us from today?
Yes, I'm up north. I'm in Traverse City at Alfie Logo Gear, and actually I happen to be wearing my Small Business Briefing shirt, which was made by Alfie Logo Gear today. But we're doing an order-to-owner network meeting in Traverse City tonight, actually here at Alfie Logo Gear. So it's not too late if you want 4 to 6 tonight at this location. We'll have food and drinks. It'll be a lot of fun. But if you could stop by, that would be great. I'll be here, other members of the SBM team. You know, we have 31,000 members across the entire state. Our headquarters is in Lansing, but it's important for us to be on the ground with people in person all around the state, in every region across the state. And so today happens to be Traverse City, and we could not have picked a better day to be here, because saw the bay driving in, and just blue skies and beautiful, beautiful weather. And I noticed this morning as driving north that it just feels like the tension falls away every mile that you get closer to being up north. So, but if you do happen to be, if you're a business owner in the Grand Traverse area, in the, let's say, the greater Grand Traverse area, if you're watching this and feel like coming, no matter where you're coming from, Alfie Logo Gear. I noticed you put the link in the chat there, so you can take a look, get the address, and join us tonight. Would love to see you.
All right. Well, someone has to hold down the fort here in Lansing, but I'm glad that there's several staffers up to meet our friends and members up in that area. It is a beautiful place, and we love Bonnie. She's one of our longtime members, and many people who watched the briefing from day one might remember her fun recaps where she would recap them with some wit and humor. So make sure you tell Bonnie hello. All right, so we have a couple of topics to get to today. The first of is that the Federal Reserve met yesterday, and there was a decision to once again raise interest rates. So where do we go from here? Did they set any expectations?
Yeah, so this interest rate is 0.25%, and they had been telegraphing that ahead of time, that they were expecting another increase. The market had everybody was assuming it was going to be 25 basis points, and they did deliver. My understanding is that it was a unanimous decision among all the directors of the Federal Reserve. There's different regions across the country that there was unanimous agreement based on the economic data to increase the rate once more. There was some for a little while, especially when things in the banking industry were kind of shaky. There was some thought that maybe they wouldn't increase this time, but quickly I think they tried to establish expectations that they would. Now, looking forward, in the next, they've done 10 times in a row. They've increased 10 meetings in a row. They now have increased interest rates. There is some expectation now that they're going to take a pause. Now, if you were to look at expectations in the markets and in Wall Street, they've really priced in that it will stay the same, interest rates will stay the same, and then by the end of the year, the rate will start dropping again. This is the Fed funds rate. This is a rate that the Federal Reserve of the U.S. State government, the central bank, that rate that they set, that a lot of other interest rates are pegged to, that they will, the market thinks they're going to start dropping it by the end of the year. The Federal Reserve absolutely did not set that expectation themselves. I think the market is just looking at it saying, well, it looks like the economy's, there's a lot of sign that the economy is starting to slow. There's stress in the financial services industry. And so the expectation is, hey, these interest rates, all these interest rate hikes that have already happened, they're going to do their job, and the Federal Reserve is going to then start putting the rates back down lower. But I thought that the Federal Reserve, and Jerome Powell in particular, was very careful not to set the expectation that there would be any rate decreases this year, and in fact, not to take the idea of additional rate increases off the table. I think the only expectation that was set was that they're gonna let this one settle for a while and see what happens. And depending on what happens, they'll make future decisions on whether they need to be increased more because inflation is up, or decreased if the recessionary concerns come to fruition, and they need to start moderating the impact of the previous increases.
Are there any other factors at play that would determine whether or not they increase or decrease those rates?
Yeah, I think the main factors are going to be employment. Number one will be employment. So what happens in the job market, the number of jobs that are created month over month, and while the recent months have looked more moderate, they still were pretty solid job growth months, but certain industries you do see some fall off that is starting to happen in overall hiring. Unemployment data does show that new claims and continuing claims are a bit, running a bit higher than they were in the past. So I think that employment will be the top thing that they'll look at. But I also think they'll be careful to very closely monitor liquidity within the financial institution industry, so banks and credit unions, that every time they increase interest rates, it really weakens the balance sheet of banks, even though it creates income opportunities for them, just depending on how much liquidity that they have. So this is a balancing act, and so if employment cools off, it'll be a good indication that that inflation can cool off. Because remember, when we look at the inflation numbers, core inflation, especially in the service industry, that still is high, uncomfortably high. And so commodities and durable goods have started to, that inflation there has come down nicely, but the service industry, which is, by the way, driven mainly by the cost of labor, is still pretty high. So I think that's really, they'll look at inflation, but they'll also look at employment to determine whether or not they need to increase or decrease in the future. But I think for the time being, until further notice, I think that with respect to interest rates, we'll see kind of an even status quo at least for the next few months.
And when we talk about interest rates and we're watching them increase, what does that mean practically for borrowers? What's the difference now versus maybe a year ago?
Yeah, well, there's been a series of increases, and while the rate that they're increasing is, it's the rate that if a bank borrowed from the Federal Reserve that they would pay, or if they're depositing with the Federal Reserve, it's tied to what they make if they deposit and what they pay if they borrow. But the car loans and mortgage loans and credit cards, these are in business loans, lines of credit, they're either directly or indirectly tied to this base rate, which is like the what would be in the marketplace the risk-free rate. And so I was looking over and some of the indexes that show what the overall or the kind of average borrowing costs are for different types of borrowing and how they've moved. And so we've seen 10 increases in a row, and with the Fed putting it now above 5%, and that's just in the course of a year, so a pretty short period of time, a big move. Credit card interest rates, the average credit card interest rate now in America is above 20%. So there was a while when you could get pretty good deals on credit cards in the single digits in terms of interest rate, being an unsecured loan, that those tend to be higher. But now the average over 20%. Mortgage interest rates rising, the average rate of a 30-year fixed rate mortgage now about 6.5%. A year ago was 3.25%. The car loans, another one, most people borrow when they buy a vehicle. 6.9% was the average 5-year car loan rate, and a year ago it was 4.5%. So the other thing I was going to mention is that Goldman Sachs, they estimate a widespread pullback in bank lending. And so like rates going higher is one thing, but with respect to bank activities, I did note that there's different projections on this, but as banks want to make sure that they have enough liquidity when interest rates go higher, there's all kinds of options. People can put their money places and make money on their money, right? So one place you can have it is, say, in a bank or credit union. I think that banks and credit unions are just at a position where they want to make sure they maintain liquidity in case people pull out deposits because they found some higher rate somewhere. And the best way for a bank and a credit union, or the most direct, straightforward way for a financial institution to build liquidity is to not make new loans. And so this projection with Goldman Sachs said that that if that's the case, if that's the reaction that the financial institution industry has to these liquidity concerns, is to just pull back on lending, not make as many loans, that it could have a 0.4% impact on overall GDP, economic growth this year. That would be enough to, based on what is expected to happen with GDP already, to put it from modest growth or even into recessionary period territory. So I think that these are pretty big swings, and even though it does seem like the interest rates have had a relatively slow impact on economic activity, it's starting to mount up with these types of increases, proportionately making borrowing that much more expensive. It hits durable goods first, things like cars and homes. And that's where you do see some of the inflation under control in those areas, and even some deflationary pressures. It really is the biggest question left in my mind is, how long does it take for these slowdowns, the aspects of the slowdowns to hit the service industry?
All right, and you just mentioned the baking industry. You actually filmed a video yesterday about the baking industry and attempted to answer the question, are we done? Do we need to worry anymore? So can you kind of give us the Cliff's Note version of that? And I will mention it's currently on SBAM's Instagram account. So if you can want to watch the whole thing, it's on Instagram, and it will be up on LinkedIn and our website later today.
I think it is worth answering this or asking this question and thinking through, are we done with what seemed like it could be a financial institution crisis a few months ago? And the conclusion I've come to is that unless something changes, yes, I think we are. That the issues with the three banks that failed, the most recent being First Republic, that they seem to be pretty well contained. There was a list of a handful of other banks that were kind of on the concern list. Those banks seem to have stayed out of trouble in terms of there no runs on those banks, and therefore it really does look like these banks that had a lot of long-term obligations at very low rates, so they had that in common, and then also a high proportion of uninsured deposits. In other words, people that had deposits well above the FDIC insurance limits. It made them vulnerable to a run on the bank. Now, it's been a long time since we've seen that as a problem in the financial institution industry, but I think across the whole industry, because, well, really any bank would have a problem if everybody withdrew their money at the same time. And so it really did beg the question, how big a problem do we have here? And now that we're into it, we've seen these three banks that the FDIC essentially took over and quote unquote sold, but really they gave the banks away to other bigger banks, and these three, but it seems to be contained. So I think the answer to the question, are we done with this, what looked like it could be a financial crisis before, at least for now, I think that we are. The big questions left in our mind, is there something else that changes every time the Federal Reserve increases interest rates? It does put stress on the balance sheets of banks, but it's also, but I think also the bigger concern is really what happens with the broader economy. Usually, if you look historically with trouble in the banking institutions, you'll see that it's centered more in the area of credit quality. So make loans go bad, people don't pay the loans, and bank takes losses. that's really the sort of activity, overall kind of economic calamity of 2008 and 9, especially here in Michigan. That's the sort of thing that can really hit banks hard, the more traditional way that banks have in modern times have had some issues. If we have a really harsh recession in the future, of course, that's a new factor. But as things stand today, I'm hopeful that we're through it.
All right. And like I said, we will have that video up on our website yet today, and it is on Instagram. All right. One final topic for today, Brian, and it's about the auto industry. So we're giving incentives for creating new jobs, but current jobs are being eliminated. So how does this line up?
Yeah, I thought it was kind of interesting, kind of shocking actually, when I saw some comments yesterday from Sean Fain, who's the new head president of the UAW, so the main union that represents auto workers. And naturally, those unions tend to be aligned more with the left side of the political aisle and supporting Democrats, but really a pretty harsh warning to President Biden from the new head of this union, saying that the union will withhold its endorsement of President Biden's reelection until the administration throws its weight behind a just transition, their words, to electric vehicles. And there was a letter to UAW employees to that effect. It came about a week after Mr. Fain's visit with lawmakers in the Biden administration in Washington. And now, so normally it'd be kind of given. A union wouldn't, you got an incumbent president of the party that unions normally support up for reelection. It would be kind of a given. And this was a pretty aggressive move. And I think that here in Michigan, it's something that the political system probably will pay a lot of attention to, but also as they enter into union negotiations in the coming months here in the summer, with major automakers here in Michigan, that well, if they play this rough with President Biden, it's probably going to be, they're in for quite a confrontation with respect to negotiations. But this really is the sort of thing that's right now directed in Washington at the federal incentives for buying electric vehicles. So that the union's beef seems to be, hey, the Inflation Reduction Act, which has these really big subsidies for buying electric vehicles, those didn't have any strings attached. So automakers are free to eliminate combustible engine jobs, and that while they're making the electric vehicle jobs that are not necessarily better jobs, could be fewer, they will be fewer of them in the future because there's far fewer components. And so how are workers going to fare throughout this transition? So the union is saying, hey, I want the Biden administration not to just give out incentives for buying electric vehicles, but to put strings attached to say, you got to make sure that the workers are taken care of. The reason I think this is relevant to pay attention here in Michigan is not just because there's still a heavy reliance on the automotive industry, and you got union negotiations coming up, and there could be any number of things. I'm not even going to say the words out loud, but the things that happen when there's union negotiation breakdowns, like that stuff could happen here, and it has a big impact. Kind of a local impact here, bigger than around the country. But I think there's also, I do wonder whether or not the labor union is looking toward Michigan in the way that it does incentives. So big incentives to the automotive industry. Will the union look to the state to say, hey, you're doing these incentives and you're not attaching enough strings to ensure that workers benefit from it. So it's something to watch. When Mr. Fain was first won the election to be the new head of the UAW, it was on a platform that I thought was it was notable how aggressive the language was. And as we look at the things that have happened here, I think that yesterday was even more notable. Again, kind of takes a lot to surprise me in the system, and seeing the head of what I think is the biggest private sector union call out the president was something that let's just say it wasn't on my bingo card this year. So there'll be lots to pay attention to there, and can see how this plays out, especially through union negotiations later on this year.
All right, well, that is all we have for today. Brian, enjoy your time in Traverse City with our members this evening. Everyone else have a wonderful rest of the week, and we will be back here Monday at 3 p.m.
Thanks, everybody. See you next week.